Hi there, welcome to Peterson Wealth Services Point of View today. It's Wednesday, October 26th. So here we are in the middle of fall, and I want to share with you a couple of things that we're doing right now here in the office to take advantage of where the market is in this year and the decline that we've seen so far. I've got written on the board here behind me, tax loss harvesting. And I want to make a point to explain what that means. You think about any kind of harvest and you're thinking about kind of gathering things, reaping what you've planted, and hopefully storing that and using it for years to come. We can do that with tax losses. Now, no one wants tax losses when you're thinking about investing. But as you know, if you've been an investor for any length of time, you're going to find from year to year or from time to time, you're going to see securities drop in value. Now, that's not permanent. Remember, we're always talking about the nature of being a long-term investor. But when you find these temporary declines, there's something that you really want to look at, and that's what we do. We think we add a lot of value to our clients by tax loss harvesting some of these declines in security price. The capital gains rates you're going to find yourselves in if you sell anything are 0, 15, or 20. And all that depends on is your income for the year, where you're going to find yourself. For example, 0%, you're going to have to be under 83,000 approximately. If your earnings are between 83 and 517,000, you'll pay 15% most likely. And then anyone earning over 517, you'd be at that top tax bracket of 20% for your capital gains. So remember, last year we had a lot of gains booked, a lot of things that have gone up. When we sold something to rebalance back to a risk tolerance that we were comfortable with, we had to sell and we had to book a gain. Gains are great. People love gains. They just don't like to share it with the government. So what we try to do is harvest some of these losses when we can. That way, when we do book some gains in the future, we're not going to be subject to sharing all those with the government if we can avoid it. So how does a tax loss harvest work? Well, let's take any kind of security, and it could be anything, but one that comes to mind for me is NVIDIA. NVIDIA is a chip company that we've owned in our model. Remember, you could replace this with anything, a mutual fund, a bond, an ETF, a stock. I'll use this just to keep it more interesting though. So NVIDIA had a really big year last year. It more than doubled its share price. So most of our clients who owned it for the whole year last year saw a gain booked when we trimmed it back multiple times. This year, however, we've seen clients who've seen that share price cut by about 50% or even 60% on NVIDIA shares. So if we had a client that owned this stock just this year, for example, and they seem nothing but a loss, why wouldn't we take advantage of that and use that as something that could be productive? So if we said we bought NVIDIA at 100, for example, or 200, and the stock moved throughout the year and now it's trading at 100, and we have a $100 loss, I want to take and book that loss for our clients and use that in an effort to help avoid capital gains in the future. So I take that $100 difference, I book the loss, and now that's going to be applied to my 1099. It's going to offset, because when we're looking at gains and losses, we net the two out. And so hopefully we would see a net result of either a wash or potentially further losses that we can use going forward. These losses can be used as many years into the future as we want them to be used, as long as we haven't offset them with gains. So we're going to book that loss. Now what we're going to do, we're going to put that in money market and just sit on it, hoping that stocks don't take off while we're waiting. What we're going to do is typically buy a different fund that's going to represent something similar to what we owned. In this case, what we did is buy an ETF, exchange traded fund, that's going to own like tech companies. So if the tech market moves higher, we're going to be participating with that money. So let's just say we bought this security with the proceeds of what we sold. If we sold that and we got $10,000 when we sold it, we'd put the $10,000 into that fund. Now, why do you say wouldn't we just buy it right back immediately? The reason is because the IRS has set up a rule, and it's called the wash sale rule. And I want you to remember that, so I'll write it down really quick. Wash sale, whenever you hear this or see this, the wash sale rule means that we have to wait 31 days before we can buy that security back or repurchase it if we want to use that for a loss. That brings me again to the conversation. is we book that, we have to sell NVIDIA. We can buy something else, we can leave it in cash. Our choice is to buy something else so we don't miss out on a really big upswing in the market. So then we wait the 31 days. Once that's satisfied, we can then sell this and repurchase NVIDIA if it's the security that we want back in that model and we want to continue to own it. So now our basis, which was originally 200, when we repurchase NVIDIA, maybe we're back still at $100 where we sold it. Now there's a chance that we might not be at 100. Maybe it's gone up and we're buying it back at 120. So we sold it at 100 and we bought it back at 120. That doesn't look good. But remember, we owned this in that period of time. So most likely we would have seen that increase to avoid any potential miss or opportunity cost of the market going up. So that's why we put these placeholders in. That's what we're doing when we see some of this movement going on toward the end of the year. That's what you're going to see when we sell securities and then you see us buy them back in 31 days. Some people get the wrong impression that we're doing that to make money for ourselves. Please remember, there's no commissions charged at our firm. So we don't do this transaction stuff for our benefit. We're doing it for your benefit. So you can help offset gains that you might have in the future, that you'll most likely have, like we had last year. So we store those, we use those as we go forward. I hope this made sense to you. If you want to talk about your specific situation, please call us and we can go through your account individually and see where it might apply to you. This is only going to apply again to the accounts that are taxable, not your Roth IRA, not your regular IRA or your 401k, just your investment account like your joint account, individual account, your trust account. So we'll make it more clear if you want to get some further detail about your specific situation. One final comment. Our firm is now launching a new podcast that we're going to be streaming out and sending to you all, and you'll know more about it as we get a little closer. I'll watch for that in here in the next 30 days or so. It's going to be called Harnessing Your Wealth. We're going to share a lot of information that we do here, things that we're seeing in the industry, things that we learn about, concepts around money, and we're going to be bringing some very interesting speakers to you and learn about them, what made them build their business, how they've managed through some of these economic downturns, and you might gain a lot of information that would be helpful for you and your situation. Until next time, thanks for joining me and have a great day.